Michelle Meyer up early with Bank of America, Merrill Lynch, and a single best chart with her on our economics, how it ties into our market, and then as she wants to talk about how it ties into confidence. This is an Alan Greenspan chart. Down we go correction, down we go bear market here in December, ugly, and boy, have we bounced back. Does that mean confidence has bounced back?
I think it's an important factor. So we did some work this past week where we looked at the reasons behind the move in consumer confidence. And the biggest reason for a confidence shock is the move in the stock market. That's followed by...
The stock market still matters. Greenspan 101.
It matters. It matters. And then that's followed by the unemployment rate and gasoline prices. But the number one factor to lead to big swings in confidence is the stock market. So the stock market has rebounded. We should see confidence come back in.
Naira?
So actually, when people talk about the Fed becoming market dependent rather than data dependent, Michelle, they're not missing a trick here.
Well, I think, the Fed being market dependent, it kind of appears like they are reacting very much to the data that we've seen recently. But that's because they're thinking about how the market filters into the real economy, and the conduit for that is confidence. So when you have big market corrections, that starts to weigh on real economic activity because confidence deteriorates. You always have to wonder, what is the market telling us? So I think that was in the calculation of the Fed. The Fed was worried about what was happening at the end of last year, and they simply want time to see how it filters into the economy. And I'm sure they're relieved by the fact that the stock market has rebounded, and they're hopeful that that lends itself to stronger confidence for both consumers and businesses.
Right, so that rebound that Tom has shown on his chart then, is that enough for the Fed now to start thinking about hiking again?
Well, I don't think they're at the point where they can flip back the other way. They just came out with a really dovish pivot. I mean, Fed Chair Powell was unwilling to say the direction of the next move, whether it's going to be a hike or a cut, or they were just going to simply stay on hold for an indefinite amount of time. So I think for the time being, they're going to keep this dovish talk. They're going to talk about patience. We'll see what happens in the March meeting. They have to release a summary of economic projections, so they're going to have to say what those dots are going to be. So by late spring, maybe we start to hear a little bit more of a talk about the possibility of hiking again.
We got so much time to go here. We got 30 seconds left in the hour. You're killing me, Michelle. I mean, bring up the dots. Jason, Jason, run over here. There, look at how he does that. You can only do that. He was on the sideline falling asleep at the Super Bowl last night. The market's a million miles from the dots, aren't they?
Yeah. And that's going to be the challenge for the Fed. So in the last meeting, which we just had, it was just Powell commenting. Yeah. There were no dots. In March, there will be dots. So we'll see how the Fed handles that.